Welcome. This is a quick application guide for investors on how to use the RISC Index via RentFax to compare two investments when you're looking in the same market. So this particular guide is answering how do I use the RISC Index to compare investments in a market. Hopefully at this point you have some understanding of the RISC Index and what the scores mean. If not, a brief review is the RISC Index goes from 0 to 100, 0 being low stability. And what we're referring to is the stability of rental income coming in from a rental property given its location. On the upper end of a 100 score, we have high stability, meaning there is high stability in the rental income coming in on a rental property in that location. So the way you want to use the RISC Index when comparing investments is you are using the risk associated with the location as it compares to the quantitative opportunity of the same investment, the risk-reward balance. So quantitative evaluation is just what the return is. What is the cap rate or whatever metric you want to use, whether it's net operating income, cap rate, cash on cash, all those metrics. They're quantitative metrics of your expected return. And so what you want to balance out is what is that return as it compares to the risk. So let me bring up an example here in Kansas City of opportunities that may come up in a fairly tight geography. So I'm going to go to RentFax now, and here what you are seeing on the screen is the maps version, and it's a heat map. So again, you're seeing the spectrum, the volatility or the stability spectrum of high stability, low stability, and then these colors are translated onto this map in this location. I've pinned some random addresses here to just keep this guide generic, but you can see here that if you were evaluating these opportunities that we pinned here, that you should not have the same expectation of a financial return for this property as you would for this property. This pink or red shade is exhibiting higher risk to you as the investor, whereas this light green shade, which falls here on the upper end of the scale, is exhibiting less risk. If both of these properties were presented to you with the exact same financial return, you would obviously want to place more emphasis and further evaluation on this opportunity. This opportunity here would give you a higher likelihood of achieving your financial goals or having a more enjoyable journey in reaching those goals. Whereas this low stability or higher risk location would introduce a higher likelihood that those financial results would not be attained. If you were evaluating two properties that were in closer proximity in the risk spectrum, within 5 to 10 points, the nuances become more subtle and other characteristics of the investment opportunity may emphasize more weight. But when you get drastic changes, it will definitely guide you into better decision making. As the changes are more subtle, it fades away. The benefit to a map is we can see when a property is introduced here, you've had a positive investment experience with this property, and one just to the north of it is presented to you. And without any due diligence or effort, you make the assumption that these census tracts or neighborhoods are going to behave the same. This is why even in fairly close proximity, there can be fairly drastic changes in the risk presented. So this guide goes back to answer that fundamental question of how do I use the RISC Index to compare investments in a market? Well, ultimately, what you're going to be looking at is what is the difference between the risk scores of those two, or the properties or opportunities you're pursuing, and how does that translate to the financial return being advertised or that you've evaluated to that point. Between that risk and that reward, between those two, you'll be able to draw better conclusions and better guide your next steps of which opportunities are most likely to achieve your goals.